When it comes down to it, figuring out our finances is the single most important thing in our lives. And the second most important thing is to understand the financial and banking system behind it, since they are deeply ingrained in every aspect of our lives. But the convoluted financial and banking system makes things even harder to understand. You might even consider the banks as evil. They single-handedly caused the 2008 financial crisis. And well, as for Lehman Brothers, you know what happened. But do you really understand how the banking system works? How the different groups within the bank interact with each other? And most importantly, how do they really make money? The goal of this video is to help you understand the different nuances of the American banking system. My name is Ben and welcome to my channel. And hopefully by the end of the video, you will come away with a better understanding on how an investment bank works. With that out of the way, let's roll.
Welcome everyone. To help you understand some of the concept a little bit better, I will divide this video into three main parts, with each part focusing on a specific bank functions, which will include banking, markets, and asset management. Before we begin, I do want you to keep this idea in mind, which is the idea that effectively a bank is a facilitator of capital. Kind of think of them as a bridge that connects willing buyer and willing seller of capital, and the car on that specific bridge is kind of like the money flows. And the tolls that you pay to be part of that system is the fees that you pay to banks to generate a specific transaction. Now with everything out of the way, we could begin. All right, let's start with banking first. In the banking space, it is usually divided into four main parts. With first of them being retail/consumer banking, then you have the corporate/commercial banking, then you have the private banking, as well as the investment banking that most people are familiar with. Let's start with retail banking to begin, which is something that most of you are already familiar with. But let's take JP Morgan as an example. A bank like JP Morgan tries to make a profit between the amount of interest payment that they pay you to have your money to be part of their savings and checking account versus the amount of money they charge you when you actually borrow money from them. And oftentimes, this is something known as an interest spread. Next, we have the private banking/wealth management services. Unfortunately, for average people like us, we're most likely never going to be using our private banking services anyway, since most of the time they're only reserved for high net worth individual. In terms of eligibility, let's take Citibank as an example. To be eligible for private banking services, you need a minimum net worth of $25 million, which is something like most of us would never attain anyway. So it's kind of out of the picture. To be honest, just kind of think of private banking as retail banking on steroid. But you usually get a dedicated private banker, which would help you kind of create additional custom-made services to help you with your financial planning. On top of that, you also get additional services like access to alternative investments such as hedge fund and private equity, and also estate planning, and also my personal favorite, which is private jet financing as well. The way they make money is really similar to the retail banking team, whereas they just kind of want to sell you as many products or lend you as many loans as possible so that your finances is completely tied to their ecosystem. And at the end of the day, you just kind of never leave. Now with all these basic stuff out of the way, let's move on to the fun stuff, shall we? Corporate and commercial banking. Let's start with the basics. Both commercial and corporate banking business model is essentially the same. Their main goal is to kind of lend out money to corporations so that they could generate income from those loans. The only difference between commercial and corporate banking is essentially the size of the company that they provide service to, which is usually broken down in terms of annual revenue or market cap. The way corporate banking makes money is quite simple. Effectively, they just provide loans to corporations, but most of the time they even loses money simply because of regulator having a high reserve requirement. And also with the low interest rate right now, the banks just don't really make enough money on their loans. So oftentimes the loans that they pay is kind of like the price they pay to kind of initiate the relationship with the client. The juicy return where they make lots of money is simply through cash management products, foreign exchange, interest rate derivative product, as well as traditional investment banking products like M&A, equity issuance, and bond issuance as well. And the teams are usually split between different coverage groups similar to investment banking. So in general, you get teams like technology, retail and consumer, industrials, healthcare, and real estate, just to kind of name a few. In terms of the team makeup, the coverage team usually consists of several senior bankers who kind of serve as the relationship manager to kind of manage the relationship with the client. And they will also serve as a point of contact and help facilitate transaction between different product partners within the bank as well. And all of these senior bankers are supported by a group of junior associate as well as analysts to kind of help facilitate a specific pitch books or help underwrite a specific transaction or credit as well. And most of the time, the senior bankers are more of, managing the relationship, facilitating the transaction, whereas the junior folks are more of the number crunching and doing the analysis as well. To kind of help you understand a little bit more about this specific group, I think it would be helpful to kind of run you down of a traditional underwriting process. Now let's get to the underwriting process. Usually the underwriting process is quite straightforward. Let's say the client come in with a credit ask and they be like, hey, we need $200 million to build a new factory plant. Then assuming the bankers are willing to do the transaction and they say yes, assuming that the bankers want to help them out after initial discussions, then this moves to the next steps. Then the whole team will start a process known as the green light approval process, which is kind of like seeking approval from super senior people within the bank to allow the deal team to continue with the deal. But before the actual final meeting, the deal team is responsible to create a green light memo where it is kind of like a presentation where they kind of outline the overview of the business, the financial profile, the credit profile of the company, and any potential business that they might earn and why this deal makes sense. The pitch deck is then used during the meeting with the risk department, and then the risk department would then decide whether or not it makes sense for the deal team to continue the transaction. And if the risk department has any additional questions, then that will be a follow-up that the deal team has to address. Assuming everything goes according to plan and the bank is awarded lead arranger, which is also known as left lead, what that means is that going forward, that bank will be the main point of contact for the client to facilitate the entire transactions. And of course, they will also earn additional fees to be the lead arranger for that transaction as well. Make sure you do remember this concept because this concept will be really important when we talk about the syndication team later on. After the green light approval process, the actual full underwriting process is actually quite simple. You just kind of do additional due diligence on the company and answer any additional follow-up question that the risk department might have during the green light approval process. And generally speaking, you would set up additional meetings with management just to kind of either get additional information from them or answer any sort of questions that you might have. At the same time, as a left lead, their job is also to help price the loan as well as to find other bank partners with really good balance sheets to help put this entire deal together. At this point, I think you would ask, why can't the bank just do the entire deal by themselves? Well, the capital that the bank has is usually quite limited. So naturally, you want to preserve your capital as much as possible by inviting other banks to help you out in the transaction. At the same time, this also helps you to diversify your credit risk by sharing some of those risks with other banks. So since the coverage team is not really the expert in the loan market per se, so they usually rely on the loan syndication team to help them out. The loan syndication team do three main things. 1, loan pricing. 2, loan facilitations. And 3, advisory. So kind of think of them as someone who bridge the credit market with the senior bankers. And to help price the loan it is usually not really rocket science. The criteria for comparable transaction is usually quite straightforward. It will either be similar industry, similar company size, or similar term structure. And effectively, anything could be used as a criteria as long as it makes sense. The thing is, pricing the loan is only part of the job. The other more important aspect of the job is also to help gauge interest from other banks as well as institutional clients to see whether or not they want to be part of the syndicate. And they would literally grab the phone and call other banks or clients just to kind of see whether or not they have any interest to be part of this transaction at all. In terms of the advisory services, the loan syndication team will usually work really closely with the client to help create a credit presentation which will be used during a launch meeting with other banks. They will also serve as the main point of contact to help answer any question that other banks might have. This is actually a quite important service because From the client perspective, you don't want the banks to constantly call them and ask them questions and drive them nuts. So after everything is set in stone, the coverage team will then need to put all the information that they have gathered into a formal credit memo so that they can request approval from the risk department. Since the green light process already kind of served as the basic foundation for a lot of the information, at the end of the day, a lot of the information in the credit approval is going to be really similar to the green light. But I would say it would definitely be a lot more built out compared to the green light memo. So usually you will get additional things like the structure of the deal, industry overview, highlighting several of the main risks and as well as the mitigant for it, and also talk about the expected return for this specific transactions. Once the deal team is done with the credit memo, they would then go through a final approval meeting with the risk department. Sometimes depending on the credit profile of the company, the industry they're in, and the size of the transaction, you will get a wide variety of different types of risk approval. It could range from junior approvers to country or region heads. And at the end of the day, it really depends. And once you receive approval, everyone is happy. So for junior folks, the process doesn't really end here because now that the company are officially your client, your role as a junior banker is to actively manage and monitor the company on an ongoing basis. So in general, for junior folks, they are responsible to complete annual and quarterly review of the company. If it's a private company, they will have to request financial from the client. If it's a public company, they have to actively manage and monitor the financial profile of the company. If the company do run into serious issues, that's a complete separate process that all the bankers have to deal with, which I'm not really gonna talk about today because that's a complete different process. But I'm more than happy to talk about more later on. I'm sure everyone kind of have a pretty good understanding of the different parts of investment banking. So I'm just gonna briefly go through this right now. Think about it like this: at its core, investment banking makes money through advisory services. Effectively, they charge us a percentage of fees on the transaction that they're able to successfully facilitate. Personally, I like to break investment banking down into two main categories, which is coverage versus product. Similar to the corporate banking coverage team, the investment banking coverage team is also the main point of contact with the client. But unlike the corporate banking team, the investment banking coverage team usually deal with the C-suite a lot more, since they usually partner with other investment banking product partners within the bank to help advise the client. So kind of think of them as the main salespeople who coordinate with other investment banking product partners within the bank to kind of help put the pitch deck together to pitch to the client for a potential transaction. And the coverage team is usually really similar to the corporate banking, and you usually have the typical TMT, retail consumer, healthcare, real estate, industrials, and etc. Now let's get to the investment banking product team. Let's start with the debt side of things. You first have the debt capital market, which is also known as the DCM team. They're the typical bond desks that help advise clients on investment grade issuance. What that means is that they help raise money for client with really strong credit profile that is considered investment grade. DCM product usually attract institutional investor who is looking for a steady income. So think of the pension funds as well as the insurance companies of the world who would be interested in this type of product. Next, we have the asset-based finance team, which is also known as the ABF team. Unlike traditional loan, asset-based financing doesn't really rely on the cash flow generation ability of the client. Instead, they lend based on the asset coverage. Usually, the bank helps investors get comfortable in these kind of loans through sufficient asset coverage. A good example is kind of like providing financing to gold mining company without any sufficient cash flows. You get comfortable by having your loan tied to the gold itself. And because of that, you're willing to provide that kind of financing to help the company start their operation to start mining the gold. And in general, the bank will usually hire a third-party auditor to kind of evaluate and put a value on that specific assets. And then they will lend against that assets. These assets could be in the form of an AR or commodities or equipment financing, anything that you could think of with sufficient asset coverage. Now, the risky stuff, leverage finance. And this team is responsible to raise and facilitate any loan that is considered high risk. What that means is that it is lending to company with extremely crappy credit history. So in general, the interest for these sort of loans is extremely high relative to the investment grade on the bank market, because investor needs to be compensated for the additional risk that they take to provide money for these sort of crappy businesses. And the most common product that the LevFin team provides is usually the high yield bonds and the leveraged loans, which is usually loans that are above 4 to 5 times leverage. At the same time, you can usually tell by the credit rating of some of these companies as well, like here. And last but not least, you also have the loan syndication team, which is usually responsible to help facilitate and manage the bank loan market. Like we mentioned before, the LSS team is responsible to price the loan, facilitate the loan, and provide advisory services to the company. Now that we're done with debt, let's talk about equity in the investment banking product team. Starting with the equity capital market team, which is often known as the ECM team. They are effectively responsible for anything that relates to the equity market. At the same time, they also help connect the client with potential investors and try to sell as many shares to those investors as possible. Like I said before, effectively, they're just kind of a bridge that connects willing buyer and willing seller of capital. And now we have the equity link capital market, which is kind of like a separate team that work with the trader directly to help the client whenever they want to repurchase or buy back their share in the public market. Next, we got the private placement team. They're kind of like the jack of all trade, and as you can kind of tell from the name, they effectively help the client raise capital in the private market. In essence, the private market is a much quicker way to raise capital from selected institutional client, and that capital could be through the form of debt or equity. The reason why most companies choose to raise capital in the private placement market is because of its flexibility. Since you're only offering capital to selected and highly sophisticated investors, the amount of filing requirement that you need is a lot less versus if you were to raise capital in the public market. And at the same time, you're also exempt from filing with the SEC, which helps them save a lot of time and energy when they try to raise capital in a really short amount of time. All right, now we have the M&A team. I don't really need to explain too much on this particular team. Effectively, this team helps to advise client on potential acquisition as well as merging with another company. Oftentimes, this team usually work really closely together with the coverage DCM, ECM, as well as the LevFin team, because as with any big transaction, you also need different type of financing. All right, last but not least, the restructuring team. This team generally help advise client to modify their capital structure so that they could survive for the next day. So in general, they work on bankruptcy, distressed sales, as well as liquidations. And oftentimes, this team work really closely with the ABF team as well as the LevFin team to kind of come up with an interesting capital structure or financing to help the company emerge from bankruptcy and etc. So things like DIP financing, working capital line, as well as mezzanine loans are really typical within this sort of market. Now banking products is taken care of, let's move to markets. The markets function is actually quite straightforward. Essentially, they're broken down into two main functions. One is the sales and trading team, and the other is the research team. Let's start with the sales and trading team. In the trading department, each trader is given a set of money to kind of actively generate a return in the stock or bond market. And the better you get, the bigger your books becomes and more you get paid, since your compensation is directly tied to how much money you generate for the bank. Depending on the bank, they each have a different strategy. For example, the quant desk will rely on computer algorithm to help them generate return and make trading decisions, whereas another team might rely more on event-driven strategies. Now let's get to the sales team. The sales team is responsible to engage institutional clients like the hedge funds, the insurance company, the mutual funds of the world to help push research product to them. They would then generate incomes or fees if the client do decide to trade with the bank directly. Now let's talk about equity and fixed income research. In general, research department don't really generate income for the bank per se. And sometimes they might even act more of like a cost center than anything else. But because of MiFID regulation in the past few years, institutional clients now actually have to pay to have access to some of the research and even have one-on-one meeting with the research analysts. But if you actually look at every single major investment bank on Wall Street, almost every single one of them actually have a pretty built-out research department. And the value of the research department is more to provide good investment recommendations, initiate non-deal roadshows, as well as providing corporate access to institutional clients. And the sales team is to relate those kind of informations and research idea to institutional clients so that they will actually trade with the bank itself. I will also add that unlike equity research, the fixed income research folk actually work really closely with the trading department to help them generate ideas. Take the Barclays team in New York City, for example. The fixed income research team actually sit on the trading floor with the traders to help them generate ideas and promote discussions. And last but not least, we have the asset management division. And the asset management team at huge investment bank acts more of like an institutional client. They usually consist of multiple funds with multiple fund managers that manage billions and millions of different types of portfolios. And similar to other funds on Wall Street, they usually charge a base expense fee on top of X percentage of outperformance fee against a specific benchmark. And of course, this type of fee structure really depends on the type of product that they're offering. And of course, something like an ETF would definitely cost a lot less versus a more active fund. At the end of the day, the asset management team doesn't really interact with the other function within the bank as much So I would actually categorize them more of like an individual company within a big investment bank that kind of operate independently. And that is an overview of the different front office function within a bank. And hopefully you're able to learn a thing or two from this video. And if you enjoyed this video, feel free to like and subscribe, and I will see you next time.